What if I told you that a $10,000 investment made at exactly the right moment could turn into over $100,000 without you touching a single thing? No day trading, no crypto, no waking up at 3 a.m. to watch candle charts like some kind of sleep-deprived gremlin. This exact opportunity has shown up like clockwork roughly once every decade for the last 100 years. Teachers used it to retire early. Nurses used it to pay off their houses. Regular people, with regular salaries, used it to build serious, life-changing wealth. The question is whether you'll be one of them when it shows up again. Because right now, in early 2026, the conditions are starting to look very, very familiar. I'm Jack. If you've ever followed a hot tip and lost money, watched your investments drop during a downturn, or felt unsure where to even start with investing, hit like and subscribe, and start building simple habits that grow into real long-term wealth. The pattern nobody talks about. Here's a little secret that Wall Street loves to keep buried under all the noise. Markets don't just go up, they breathe, they expand, they contract. And every single time they've contracted hard in the last 100 years, the people who kept their heads while everyone else was losing theirs walked away wealthy. Not lucky. Wealthy. There's a difference. Let's talk numbers because numbers don't lie, even when headlines do. Cast your mind back to March 2009. The world had just survived the worst financial crisis since the Great Depression. Banks were failing. People were losing their homes. The unemployment rate hit 10%. Every expert on every channel was competing to see who could paint the bleakest possible picture. It was genuinely terrifying. And yet, if you had taken $10,000 and put it into a simple S&P 500 index fund at that moment, your investment would have grown by over 983% by 2026, turning that $10,000 into more than $108,000. Not from picking individual stocks, not from some genius hedge fund manager, just from buying the market when fear had pushed prices into the floor and then waiting. That's the power of understanding the pattern. The history lesson they didn't teach you in school. This isn't a fluke, it's a repeating cycle. In March 2000, the dot-com crash sent the Nasdaq from over 5,000 to below 1,200, an approximately 75% drop. Amazon fell from $85 to $6. People said tech was dead. They were wrong. Those who bought strong tech in 2002 saw approximately 6 times returns by 2007, and those $6 Amazon shares, now worth thousands. Then 1987, Black Monday. The market dropped 22% in a single day. Panic everywhere. Yet it recovered within 2 years and doubled within 5. The pattern is always the same. Fear to crash to recovery to new highs. According to Covenant Wealth Advisors, $1 invested in the S&P 500 in 1926, with dividends reinvested, would be worth about $20,000 by March 2026 through wars, recessions, and every crisis in between. $1 to $20,000 through everything. If that doesn't get your attention, nothing will. Why it keeps happening. Why does this cycle repeat? Why do smart people keep making the same mistake? 2 words, fear and greed. Markets aren't driven by logic. They're driven by emotion. When things are good, greed takes over and prices rise beyond their true value. Then a shock hits, fear kicks in, and people panic sell. Not because businesses failed, but because everyone else is. But as Warren Buffett understood, during crashes the businesses don't break. The prices do. When Apple dropped to $12 in 2008, iPhone still worked. Amazon didn't stop selling. The value was still there, just cheaper. Be fearful when others are greedy, and greedy when others are fearful. That's not a slogan, it's how real wealth is built. What's happening right now in 2026? Here's where it gets interesting, and relevant to you sitting here in March 2026. The S&P 500 has now posted 3 consecutive years of strong gains, advancing 16% in 2025, after climbing more than 20% in both 2023 and 2024. That's an extraordinary run. The kind that gets everyone excited. The kind that makes your coworker start talking about stocks at the office coffee machine. But here's what that same coworker probably doesn't know. The S&P 500's Shiller-Cape ratio, an inflation-adjusted measure of stock price versus earnings, currently sits at close to 40. That's the second highest reading in the index's history. The only time it was higher was right before the dot-com bubble burst. And in 2026, the market has experienced elevated volatility, with year-to-date returns hovering near zero, despite significant market swings. Historically, the S&P 500 has experienced average intra-year declines of roughly 14% since 1990, even in years that ultimately finished positive. Translation: volatility is normal, corrections are normal. And after a 3-year bull run with valuations at near record levels, the next significant buying opportunity could be closer than most people think. Nobody knows exactly when. Nobody ever does. But the people who prepare for it, who build their cash reserves now, who understand what they'll buy when prices drop, who have a plan they'll actually execute instead of panicking, those are the people who come out the other side with real money. The rules of the game. Now, before you start refinancing your house and throwing everything into the market, take a step back. This strategy only works if you follow a few non-negotiable rules. Rule 1. Only invest money you don't need for at least 5 years, preferably 10. This isn't rent money. This isn't your emergency fund. This is money you can lock away, ignore the news about, and let compound in peace. If you'll need it next year, leave it in a high-yield savings account. Rule 2. Focus on diversified index funds, not individual stocks. Unless you have a team of analysts and 20 years of experience, picking individual winners is genuinely hard. According to NerdWallet, the S&P 500's long-term historical average annual return is approximately 10%. The vast majority of actively managed funds, run by professionals with billions of dollars and MBAs from everywhere, consistently fail to beat that number over time. So don't try to be a hero. Buy the whole market. VOOVTISPY. Simple, boring, and historically effective. Rule 3. Use dollar-cost averaging. Don't dump everything in at once. Divide your investment into chunks, say 20% per month over 5 months. If prices drop after your first purchase, you're buying the dip automatically. If they rise, you've still got money in the game. It takes the pressure off trying to nail the perfect entry point, which, spoiler, nobody ever does. Rule 4. Turn off the news. Seriously. Research shows that missing just the 10 best trading days in the market can cut your total long-term returns by roughly half, and missing the top 50 days can reduce returns by nearly a factor of 5. Those best days almost always happen during periods of peak fear and volatility. Right when everything feels like it's falling apart and your instinct is screaming at you to sell. The people who stayed the course captured those days. The people who panic sold missed them. The real cost of waiting. Here's the thing that keeps most people poor. They wait until it feels safe to invest. They wait for the recovery to start. They wait for the headlines to turn positive. They wait for their friends to start talking about their gains at brunch. And by the time all of that happens, the best buying window has already closed. The people who bought at the bottom of the 2009 crash didn't feel brave. They felt terrified. The people who invested during the COVID crash in March 2020 had their families thinking they'd lost their minds. The people who bought Amazon at $6 during the dot-com crash were probably getting some very strange looks at dinner parties. But they bought anyway, because they understood one thing. The best time to plant a tree is when everyone else is pulling theirs out of the ground. Think about what that means in real terms. Someone who invested just $1,000 in the S&P 500 back in 2005, through the 2008 crash, through COVID, through all of it, would have seen that money grow to $4,487 by the end of 2025. That's without adding another dollar. That's without checking the account every week. That's just patience doing the heavy lifting. Now imagine not $1,000 lost, but $10,000 or $25,000 invested at the right point in the cycle. That's not get rich quick. That's get rich patiently, and honestly, it works a lot better. What to do starting today. You don't need a finance degree. You don't need a Bloomberg terminal. You don't need to understand what a PE ratio is, although honestly, it's not that complicated, and we'll do a video on that soon. Here's the practical playbook. Start building your cash reserves now. Not to hoard cash forever, but so that when the next big correction hits, you have ammunition ready to deploy instead of watching from the sidelines wishing you'd prepared. Identify your vehicles. For most people, VOO, Vanguard S&P 500E, TF, VTI, Vanguard Total Stock Market ETF, or SPY, SPDRS, and P500 ETF are the simplest, lowest cost tools available. Not sexy. Wildly effective over time. Make a written plan. Decide now what you'll buy, how much you'll invest, and at what drop level you'll start buying. 20% down? 30%? Pick your number. Write it down. Commit to it. That plan will be the thing that separates you from the crowd when your stomach is telling you to run. And then, execute the plan regardless of how you feel. That last step is the one that actually matters. Anyone can plan to be brave. Almost no one actually is when the moment comes. Here's the bottom line. The stock market has corrected by 10% or more roughly every 1.2 years since 1980 on average, and has recovered every single time. Every crash has been followed by a recovery. Every recovery has been followed by new all-time highs. That's not optimism. That's 100 years of documented history. The people who build real wealth aren't smarter than you. They're not luckier than you. They just understand one thing you now also understand. Cycles are predictable even when timing isn't. And they're prepared to act when everyone else is running for the exit. 10 years from now, people will look back at this period and say something like, "Can you believe how cheap things were in 2026? Just like they said about 2009. Just like they said about 2002. The only question is whether you'll be nodding along or wishing you'd done something. The information is in your hands. The decision is yours. And if this gave you something to think about, do us a quick favor. Hit subscribe and drop a like. We put out videos like this every week, and honestly, the algorithm gods demand tribute. See you in the next one.